G'day, it's Peter Bender from Bundaberg Commercial, and it's been a big week for both our business brokerage and our property side of the business. We had two contracts, one which was signed and another one where the offer to purchase has been accepted, which is the stage when we drop it off to the lawyers to make the contracts happen and magic eventuates. What was interesting is both of those contracts had large vendor finance components. And I thought, I've been meaning to do a vendor financing video, so I thought, pretty good time to get that organised. So we'll go through the main areas or the three main areas that you need to look at if you want to offer a vendor finance option, and also some of the thinking that goes through from the seller's point of view. So you can appreciate what sort of objections you may get and be prepared to meet those objections and hopefully get a deal organised for you. I'm going to go through three clients that in the last 6 months where we've organised vendor finance options. So it'll give you a bit of and they're different industries, so it'll give you a bit of an idea of what is available. Previously, you'd have vendor finance only applicable for large sales, as in, the $1 million plus sort of options. And it was probably only about 20 to 30% of contracts that would have a vendor finance. And that can be a small component of the purchase price, or it could be like the majority of the purchase price. So the first thing you want to have a look about is how much of the purchase do you want to look at trying to get vendor financing for. And now what we're finding is it's probably closer to 50% of sales that are being put forward have a vendor finance option. And it's not just the big end of town. It's, the deals that are around about the $250,000 upwards. So it's a changing environment. And it's largely due to the fact that the economy is slowing down a little bit. And that means that finance is getting increasingly harder to organise. And buyers are looking for ways to still make their purchases and hold on to cash if they can. And sellers are also aware that the market may be drying up a little bit, so it's a good time for looking at other options if you want to get that property or business sold, unless you've got the luxury of time and you can just grab it as you need to. All right, so what are the three main things you need to have a look at if you are putting forward a request for vendor finance? Okay, first is the deposit amount. Second is the term of the financing arrangement. And the third item is in regards to payments. So firstly, looking at the deposit, recognizing that you as a buyer are going to come up and ask for a seller to be a security for you and to give you a loan, which is similar to what a bank would do. Don't be thinking that you're going to get away with a 10% deposit. Usually 30 to 50% deposit is the norm in vendor finance. You need to demonstrate to the buyer that you are someone who's got money, just not enough money. Once you can still get deals together with small, very small deposits, it makes it more challenging for you. You want to put forward a really strong case that you are worth the risk, because let's face it, essentially, if you're going for vendor finance, it's probably because the banks aren't going to touch you. Now, for whatever reason that is, it could be bad history, it could be the fact that you've got no assets backing, it could be the fact that they're not going to finance towards either that property or that business, because not every business and every property is able to get financed because of the location they're in or the type of industry they're in. So for whatever reason, if you're going up for vendor financing, it's usually because you can't get finance, so you should be considered as a risk. Not making it nasty, but this is realistic and we need to have a look at it. And the way to reduce the fear to the seller is to have a hefty deposit. Like I said, 30 to 50% is pretty normal in those sort of brackets. The good thing with commercial vendor financing is there's very little legislation around that sort of space, particularly if you're only doing it one-off. If you are considered as a credit provider and someone who does this on a regular basis, you may have legislation to look forward to. But in most instances, it's a commercial arrangement. So whatever you work out between you and the seller is fine. The solicitors will put an agreement together and make it a legal document and a contract. The solicitors and accountants will probably want to give you advice and give you recommended terms. A lot of solicitors aren't for doing vendor finance because the risk is just high, and they've probably seen a few that have fallen down, and to try and pick up the pieces of your business or your property can be quite challenging. But even in those instances, I'm finding now that solicitors, instead of saying no, and it used to just be straight out no, you're not doing it to their clients, they're now putting in some standard terms which they're comfortable with, and that's a way forward and again, sign of a change of times. All right, the next thing to look at after the deposit amount is the term. Now, recognize the main thing is the longer the term, the higher the risk. Because what seller wants is they want to have their money. They're quite often waiting to retire or they've got other plans. And if you've got something like a 2 to 5 year term, that's a significant commitment from the seller. And they could be sitting there twiddling their thumbs, not able to retire until the majority of that money is put forward. Usually, a normal vendor finance term is between 3 to 6 months. I do have clients where I've had vendor finance terms for about 2 years. And once again, it shows it's an open market. So have a look at what you're doing. The things that you need to balance is you need to balance to make sure that the seller is comfortable with a regular flow of money that's coming in and a sizable amount of money coming in, as well as being balanced by the fact that you've got to run that business. So don't put your last dime into every monthly payment because the business will need cash. There may be expansion. You may need to buy stock. You may need to put more people on board. Make sure you've got plenty of cash to run the actual business as well. A good philosophy in business is try not to have more than 30% debt. So if you work out you bought a $1 million business, then have a look at only borrowing or getting vendor finance for 300,000 of it, and have a look at between 6 to 10 months in that bracket. So you're looking at, well, mathematics is not my strong point without pen and paper. I think that's about 45 grand a month to run with. So term is the second key area, and it's quite negotiable depending on what you need to do. And also, the bigger the deposit, the more flexibility you have with term. If you have a small deposit and you're asking for a big term, then you want a real estate agent that's really good at negotiating that for you, because it is a big ask for a seller to be in that situation. Okay, we spoke a little bit about payments. So payments being the third area that you've got to look at when you structure a deal together. So the payments, you can have a couple of options. One, it is usually payments run from the business. So if you're going to buy a business and it makes 10 grand a month, you may look at giving $1,000 or $2,000 a month as payments. Some people will look at quarterly payments. I've seen yearly payments, but that really does run a risk for the seller. They don't really like that. They like to have regular income coming through. Quarterly is tolerable. Monthly is normal. And the other aspect that you need to look at is you will probably be hit with interest, probably a 6 to 8%. Because remember, if you were with a bank, you'd be paying interest on that as well. And a lot of lawyers will make sure that the vendor financing plan is a commercially viable option. And you'll find that your accountant will probably want that the same, particularly if your accountant is for the seller. Now, in regards to vendor finance, what can be financed? Once again, it's only limited by your imagination. And we'll go through a couple of options. So I had one client who was a large hardware store. And in that scenario, the deal was pretty well, the buyer paid for the business. So that's like the goodwill component of it. And they got vendor financing for the stock. They also paid outright with a deposit, and the business also the assets. So it's essentially just the stock that they're looking at. And when I say just the stock, it's like $1.25 million worth of stock. So you can understand why it was a hefty bit. And what they did in this particular instance is they had an unlimited vendor finance option, which is very unusual. But the way it worked is they knew the stock in the business. It was on a stock report. And at the end of each month, if they sold $100,000 worth of stock, then the profit component stays with the buyer, but the cost component will go to the seller. Is that right? Yes, that's correct. So what that means, if they had, if they sold $100,000 worth of stock and they had the margin of 30%. So they would sell it for, say, $130,000. $30,000 would go to the buyer and $100,000 would go to the seller. And that kept going until they reached the magic 1.25 million in this case, which is the total amount of stock they had. It gets a little bit tricky with stock because this business will be constantly bringing stock in and bringing stock out. So in practical terms, it may not be all the old stock that got sold. They may have had 400 wheelbarrows coming through when they only had 10 on the shelf, but for some reason wheelbarrows were the big seller, so they worked on that process. Whatever was the cost price of the wheelbarrows goes to the seller, and the profit goes to the buyer. And that worked out quite well, particularly because this business had taken a while to be sold. What else can be finance, or you can finance assets. Sometimes the seller will have a mortgage over the assets, particularly for manufacturing companies. If you've got CNC machines and lathes, compressors, any manner of equipment and hardcore machinery, which is pretty well bolted to the floor so that the buyer can't just suddenly get up and put on the back of a truck and disappear. Heavy equipment, the lawyers will organise to have a separate mortgage. They can write a document that the seller will hold on to the equipment ownership until all the vendor finance is paid. So equipment is another option you look at. And then you can have just a pure model where the business, the goodwill component, is what is being financed. So it can be the whole business, or it can be assets, it can be stock, or it can be the goodwill. It all depends on how you look at it and how you structure that particular deal. So what sort of things do a seller look at, or does a seller look at? My English teacher will be cringing at the way I talk and write sometimes. Cool. So we spoke a little bit about ownership. Quite often, if it's property, you may find that the owner will hold the mortgage over the property until the vendor finance is completed. You may find that they have ownership of the stock. They may have ownership of the equipment. So ownership is one of the things that is negotiable. And for a seller, the big worry that they have is, let's say you've got a 12-month vendor finance agreement. 6 months comes, you win lotto and go off to Vanuatu and never get seen again. Well, the seller wants to make sure they can get the business and assets back and be able to to reclaim the business or sell the remaining equipment to get their funds. Very similar to what a bank is. One note to have a look at: so how do you negotiate and convince a seller that you should be trusted to put together a vendor finance deal with them? Well, the two things you look at: recognize that the biggest leverage that you have is the price of the sale. If you're putting together a vendor finance, and I'll tell you now, if you're putting one together with me and one of my clients, there is no negotiation on the price. It is the full price that you pay. That is the consequence of having a vendor finance package together. You can try and get a cheaper deal, but I've yet to see any deal where the seller has taken less than the full price. So that is one thing that you need to factor in there. And that's a pleasant factor. If you put the deal together and you structure it for the full price, quite often the owner says, "Full price? Okay, yeah, hey, yeah, I don't care. Let me sign here. Let me tick it." So that's a key motivator for them. Recognize that by offering full price, it goes a long way, along with a strong deposit. Security, we mentioned a bit about that. So that is the main aspect. The other thing that is negotiable is how to look for options for vendor finance. You can have a look at businesses that have been for sale for a while. Quite often it may be because of location or business type, or there's an intrinsic issue that makes it a little bit difficult to sell. One of the clients that I've had where we did vendor finance lived in a country town. So it's difficult to get finance because banks will postcode discriminate. Yes, we're not allowed to say that, but they do. Depending on where your business is a factor on how much they'll actually lend to you. So in this town, the banks weren't going to lend any more than 40 to 50%. That made it difficult to find a buyer because it was a significant, once again, it was over the $1 million type properties that we're looking at. It had a combination of property as well as business and stock. So when it come to putting the deal there, that business had been on the market for a while. So that made them a little bit more open to suggestions. If you're on week one of the listing and everybody's ringing up and get lots of inquiries, it's going to be harder for you to put together a vendor finance package because you can obviously usually find another buyer who's got a better package with either finance approved or cash. So one of the things to look for is how long has that business been going on for? The other aspects that you can have a look at in vendor finance is, is it someone who's open to options? Some people are. They're entrepreneurial and being in business, they're used to looking at different options. Or is it someone who's just going to be fixed and just wants a very much straight down, nice and simple process in regards to pricing and packaging? Now, I said that we had three clients. So one was at the hardware store, the other was the country business. So in the case of the country business, the package was such that the buyer was buying the property and they would take over the ownership of the property, and they were going to have the vendor finance for the assets of the business, the stock of the business, and the goodwill of the business. And in this particular instance, they were going to pay two annual payments to basically just splitting the money that was owed in half, and one after 12 months and the rest after the other 12 months. So it goes to show you can have long ones. In this instance, the commercial property was close to 80% of the value of the business. So the sellers were comfortable to recognize, okay, we've really only got a 20% risk here. And they went on that sort of basis. It worked for them. There's a bit of negotiating between it. It will be a complicated contract because you've got property as well as business as well as stock. And that's where I just leave it up to the solicitors to work out. And the third one that I had is on the smaller end of town. It was only $250,000. It was in the industry of food and beverages. And in this particular instance, almost contrary to everything that's normal, but the package was they were going to put down a 10% deposit. They originally started with 5, but the seller wasn't happy with that, so they bumped that up to 10%, and that is significantly less than normal. They were going to take ownership of the business, and then they were going to pay monthly payments for, I think, the next 8 months. And those payments were pretty well going to be funded by the operations of the business, similar to that model that I had before, where the profit of the business is what's being used to pay for the funding. Now, what is interesting in this instance is there's not really much security available because it's a business that really didn't have much. It was a service industry and had a little bit of stock. So there's a fair bit of risk. What made it work is the buyer and seller, whilst they didn't know each other, they knew of each other. And the big driver for the seller was speed. They were in a situation where they've just picked up a job, basically, a really well-paying job, and they needed to basically be out of their business pretty quickly so they could focus on this job because there's a lot of international travel involved. So in this instance, the business was not on the market for a long time, but the seller wanted to sell quickly. Having said that, once again, it was a full price sale. So it's a mixed bag. It's a commercial environment where you can work out what works for you and what doesn't work for you. And it worked in this particular option. So if you're looking to put together a vendor finance package, work in conjunction with your accountant and your lawyer so that you can appreciate what it is. Put it in writing. And that's always more impressive because you can guarantee that the seller's going to want to take the offer to their solicitors and to their accountants to check out and work it out. And the things you need to look at in particular, remember, was the deposit. Remember, it was the term of the agreement and the payments. And if you wanted to be able to sell the concept, then have a look at how the seller is going to be wanting security or ownership. And remember, the biggest lollipop you can give them is full price. So if you've got other options and bits and pieces that we can share, put them in the comments below. I'd love to see what's happening in the industry and the changes and what's available for my clients, and I can share that through these type videos. And if you haven't already done so, make sure you hit the smash button so you get more of these videos and share them with your friends. Take care and God bless.